Welcome to the XY Advisor podcast, where it's our goal to help you become the best financial advisor possible and drive the positive evolution of financial advice. Established in 2017, Goodman's creates sustainable investment solutions for advice professionals and retail customers. Focusing on tools that help customers engage with sustainable and responsible investing, the goal is to play a key role in redirecting capital to environmentally sustainable, socially responsible, and ethical business. The Goodman's Advisor Portal is a discovery, analytics, research, and advice support tool designed to give advisors the confidence to determine their clients' responsible investment needs, analyze portfolio holdings, and access institutional-grade environmental, social, and governance research for over 7,000 global equities, ETFs, and funds.
G'day. How's it going? What do you know? Strike a light. Clayton here from XY Advisor. Today we're catching up with James from Morphic, and we're in the first early stages of our 5-part ethical investment series. And this is a topic that a lot of advisors are interested in, but as I'm sure you probably know, James, it's not something that a lot of advisors know a lot about. And you were very kind enough to say, you're willing to sort of come on and teach advisors a little bit about what ESG means and what it is. And we've got a handful of topics we want to get through. But before we get to all of that, what's your background and what sort of brings you here today to sort of be an expert in this ESG?
Well, Clayton, firstly, thank you for having me on today. It's my absolute pleasure. My background is over 25 years fund management experience. Firstly, in the UK, the bulk of my career then being in Europe, in Switzerland specifically, and in the last 4 years moving down to Australia and joining Morphic. I guess my first experience with ESG or the precursors to ESG were working for a reinsurance company, a special kind of insurance company, if you like, for whom they were facing a lot of newish risks in their insurance business, such as hurricanes, weather, environmentally inspired risks, as well as health risks around things like smoking. I was part of a team responsible for managing the assets of the insurance company.
Right.
The penny dropped at some point that if, on the one hand, the insurance business was being impacted by climate change, wouldn't it be, or shouldn't it be consistent if we, the managers of the assets, were also being aware of the impact of climate change on the companies that we invested in? And
right.
likewise, inconsistent if we were investing in tobacco companies, for instance, and yet the insurance business suffering from risks related to the population smoking. So this was back in at the turn of the century, around the tech boom, 99, 2000, when concurrently in Switzerland, the UN, the United Nations, backed a new outfit called the Principles of Responsible Investing, UNPRI, which was about signing up asset managers to commit to taking on board and integrating consideration of environmental, social, and governance risks into their investing activities. So the company that I worked for was one of the first signatories to that. Around the same time, an American chap called Al Gore, most of your listeners will be familiar with that name, was also very much thinking about how he could translate his environmental awareness into the financial world, and he set up a business called Generation Investment Management, which is now one of the largest institutional asset managers at the forefront of ESG investing, if you like. And we spent some time working with those guys. And back then, we really were the pioneers insofar as there wasn't an industry supplying information around the environmental risks that companies face, their carbon footprint, information around the diversity of the boards and the corporate governance and so on and so forth. So we really had to do the research ourselves. And for the bulk of my career managing money, I've been involved in researching companies. So it was a fairly natural progression to say, well, okay, rather than just researching the financial aspects of companies that we might be investing in, let's also consider these companies from an environmental and social and a governance perspective as well. So for the last short 20 years, I've been doing that. For personal reasons, I moved to Australia and through my network found Morphic Asset Management, the founders of which came from probably the pioneer in ethical investing here in Australia, a business called Hunter Hawk, no longer exists. But they set up on their own because they believed they could do a better job. And so I joined that company, a small employee-owned boutique, and since then we've increased the number of products, increased the assets under management in products that are invested globally, not just domestically here in Australia. And the other point of differentiation is that we're long-short investors. So not only do we take long positions, invest in companies, we're also able to take short positions, i.e. profit from the valuation of these companies going down.
Yeah, right. Okay, cool. Now, I guess, probably the best place to start is, what does ESG mean?
Well, the initials mean environmental, social, and governance. There's a lot of jargon around this. It's quite similar to CSR, corporate social responsibility. There's a number of different ways of expressing this. I think the term that we prefer to use is responsible investment.
Right.
That captures all behaviour related to corporate social responsibility, consideration of environmental and social and governance issues. But I think it's useful if we take a step back and look back to history as to how thinking about ESG started and where we are now. So really, you can go back a century or so to the Quakers and various other faith-based organisations who just took the decision that in their business activities, they really did not want to have any contact with certain activities that that conflicted with their values. Alcohol would be an obvious one. So back then, there were organisations effectively investing and avoiding exposure to certain industries. More recently, in the 70s, in the 1970s, the asset management industry started to take this a bit more seriously. And again, that was very much value-driven, be it the values of the client or the values of the fund manager managing the money. So as it happens in the example of Morphic and the company before that, the employees of the company felt very strongly about the negative consequences of tobacco, alcohol, of extracting hydrocarbons from the earth, of the environmental consequences of the emissions of that, of the manufacture of weapons and so on and so forth. So naturally, it felt absolutely the right thing to do to say, well, we're going to invest our clients' money alongside our responsibility to make good investment decisions. We're actively not going to invest in those types of companies.
Right.
So that really is the most simplistic level of ethical investing, as it's called. Now, as well as avoiding, one should also perhaps consider those companies that aren't explicitly in an area you want to avoid, whether they have any business interactions or any risks related to some of the things that we don't like. Now, what we believe, and our responsible investing peers do as well, is that the world is starting to price some of the externalities, some of the risks that have always been out there, but we're much more conscious of, particularly around the environment, for instance. Also around social risks. For instance, think of the gig economy and employing people on low wages and potentially putting employees into a position of sort of modern slavery, if you like, and also then thinking about the governance mechanisms within companies. Are companies accountable to their shareholders or simply accountable to themselves? Basic ESG investing nowadays really says, okay, so as well as researching companies as to whether they're good financial investments or not, we're going to look at the companies to see if we can identify any material, and that's the key word, materiality, in terms of risks related to the environment, social or governance exposures of the particular company. So at the very basic level, it's risk management. Secondly, when we're looking for the risks that the company might face in those areas, let's consider the opportunities as well. Are there any positive opportunities that the company, a particular company faces to further grow its business in these areas, for instance? Now, we as a fund manager, we integrate that thinking into all of our investment decisions. Now, the next version of ESG investing, if you like, is what we call thematic or sustainable investing. So this is where a fund manager might say, I'm only interested in investing in companies that have a specific positive environmental, social, or governance angle about them. Now, the environment's the obvious space. So you can think of funds that only invest in renewable energy, for instance, or solar funds, or water-related funds. So that's the second main area of ESG investing, and that's what we call, as I said, thematic investing. The third variety, which I think's come about much more recently, is impact investing. Now, impact investing, it means different things to different people. Our belief is that impact investing is where you explicitly expect that there is some cost to your financial return from your investment.
Right, okay.
So you might, for instance, invest in a project and take the active decision to pay away a percentage of those revenues to a particular charity. So
Gotcha.
by definition, your returns, your financial returns are lower than they might otherwise be, but there's an explicit, measurable impact on society or on the environment.
Right, so that's a pretty clear line then. So ESG, there's no expected financial impact, and impact investing, you are expecting a financial impact to yourself.
There's an explicit one. Now, I wouldn't say I would say there is still a financial impact of picking positive impact from picking companies that have good governance, for instance, companies that have a good social impact. It's just that it's harder. It's not measurable in a sense. It's difficult to pick. The explicit or measure the explicit impact of that good social behaviour or good governance. Whereas in impact investing, it's explicitly measurable, the financial impact that you're having. And then,
right, so that's more, it's philanthropic almost.
Well, so the final type of ESG that we consider is exactly that, philanthropy. So
right.
with philanthropy, your investment, you're effectively you're giving away. The cost is your capital is gone, and it benefits somebody else. There is no return to you. That's the ultimate ESG investing. Now, that's not a commercial decision, and there's no business around philanthropy other than wealthy people wanting to have a positive impact and donating their money.
Yes. Yeah. Wow. Okay. Cool. So that's a huge spectrum. So there's anywhere from like an advisor's job, obviously, is to up until very specifically told to not do this. In the case of, say, philanthropy, but the goal of a financial planner is to bring as much money into the lives of the clients as possible. So philanthropy, I guess, is sort of that, I would imagine, wealthy older individuals who just want to give back to society, whereas that's not going to be anywhere near as common as, say, advisors. Well, actually, it's probably more consumer-led. Consumers wanting to only invest in companies that don't have a substantial impact, and don't have a substantial negative impact on the world, and it doesn't have a substantial or any negative impact on their financial outcome.
Absolutely, and it's absolutely our experience talking to advisors that is a decision taken by the client. The clients are asking, people are working out that particularly in the context of their super funds, and particularly down here in Australia, because the economy is so sort of natural resource orientated, that people are working out that it's fairly certain that any one of the large industry super funds is, almost by definition, because they're investing in Australia, going to have some exposure to the coal industry, for instance.
Of course.
People don't like that. That's people, reflecting their own values in what product that they look for from their financial advisors. And at the end of the day, regardless of whether the financial advisor shares those values, the client wants it. So, the financial advisor wants to be able to provide a suitable product from the suite of products that he or she provides.
Is there something as simple as, let's say, a client just doesn't care too much, but they just don't want coal for whatever reason, just don't want coal, just happy to do whatever, they just don't want coal. Is there a way for an advisor to say, well, here is an easy solution where you get everything except for coal?
Well, there are some thematic funds that, for instance, will say, we're a hydrocarbon free, or
right.
So no oil, gas, coal in the portfolio. There's some super product that's exactly that. That's a subset of the ethical investing. Basically saying these are my values. I want to exclude exposure to that, and there is product for that. Probably coal, hydrocarbons is the biggest sort of theme, if you like, because it's up front and center at the moment in people's consciousness, the environment. You don't find, I'm not familiar with product that, say, for instance, only excludes alcohol and tobacco, or that's a smaller subsect.
Yeah, okay, I'd imagine that would be the case. What about so let's actually, there's two things I want to talk about. There's the bottom up interest. So you've got this growing groundswell of consumers and clients wanting this from advisors, and then you've also got this sort of top-down legislative, fiduciary duty, super fund trustee responsibilities. So you kind of got this squeezing from the bottom up and the top down. Can you just walk us through what you've seen so far to prove those two demands are coming together?
Well, the way that I put it is when I'm talking about ESG and somebody or the audience or somebody in the audience says, well, quite frankly, I really don't care. My values are different. Yeah. I say, well, that's fine. That's absolutely fine. Everybody has their own values. That's great.
Totally.
But the reason why I'm sat in front of that audience educating is that we can see, and the numbers suggest, that there's such a growing weight of client demand and thus money wanting to be invested in this way that, like a snowball that starts small at the top of the mountain, it rolls down the mountain, it gets bigger and bigger. Now, by some measures, over 50% of investable assets in Australia are now invested with some consideration of E, S, and G factors.
Yeah, right. Really?
Yeah, I think that's the broadest measure, and
Sure.
I think it's a really optimistic measure. But the point is, 4 years ago, that number was, say, 20%. The growth is huge. And even if you don't share the values, it matters, because if more and more asset managers like ourselves are investing on that basis, more and more of our values are going to be reflected in share prices. It makes sense that over time, if that trend continues, there's going to be more and more sellers of coal companies, for instance,
Right.
and more buyers of companies that don't have a negative environmental impact, have good social practices and good governance. So even if you don't care, I think it cares to be aware of these trends.
Well, is that from the top down? Is there sort of pressure from government pushing down to the super funds and other asset managers? Is that on the horizon at all? Has it begun? Is there any talk of it?
Oh, absolutely. Now, industry bodies such as formerly the United Nations PRI that I referred to earlier, now known as the PRI, are global and have ever-growing numbers of asset managers as members. They're imposing standards upon us. Those types of industry bodies are working with legislators in different parts of the world. So, legislation is different. The way pension super funds are legislated here is different from the US.
Sure. Yeah, of course.
But absolutely, legislators are well aware of this. And probably in the biggest market, which is the US, there's certainly active discussion as to what the definition of fiduciary duty should be in this day and age. Now, fiduciary duty is a legalistic term that goes back a long time. And particularly within the pension world, the question is, shouldn't we be formalizing this idea of considering, risks and material issues beyond just the financial, returns, as a fiduciary to looking after other people's pension money. So it's uncoordinated in the sense that what one part of the world does won't necessarily be followed. But there's, I think, again, back to this point of client demand, there's sufficient momentum that laws will change. Now, there's certainly active discussion here in Australia. It's made somewhat difficult if you think of the super industry and the industry super funds. Certainly there's some super funds who are backed by industries that, we're talking about being negative. Now, there's clearly a political angle to that. Without a doubt, in 10 years' time, there will be no question that it will be the responsibility of asset managers to consider these additional risks.
Cool. Wow. Now, if I think to the research that I've done in my time to the performance of ethical funds, there was definitely an issue, even if it was just a couple of basis points. But for whatever reason, it just seemed that ethical investing was more expensive and it got a lower return. Do you have any kind of academic evidence to suggest otherwise, that is maybe not as accurate as myself or is believed in the broader advice community?
Look, if you look hard enough in the academic world, you'll find evidence to support any assertion, any outcome.
Yeah.
But I think, trying to keep my opinions balanced, I think there is a growing body of evidence that there is not a performance cost. And I'm absolutely confident that if you just think about risk management and think about the environmental side of things, I'm absolutely confident that there are many hydrocarbon assets owned by companies that are in the ground and will remain in the ground for forever. So by definition, those assets are declining in value over time. So by if for no other reason other than risk management, looking at companies in terms of whether there's any material negative environmental exposure is going to save me money over the long term.
So you're saying there's an argument to be had that perhaps ExxonMobil has X liters or X barrels of oil under its current reserves valued at X dollars. And maybe oil's a bad example. Let's go coal. So pick some big coal company, they've got X amount of ton of coal in their reserves, which the company is valued on. And because of these bottom-up, top-down trends, we're going to see less demand for it over the long term. You're suggesting that there is a long-term downward trend to the valuation of these companies anyway.
Absolutely. So if you're measuring performance relative to a benchmark that includes coal assets, then avoiding them is going to be a good thing. Another way to answer your question is that I've yet to see somebody decompose performance into ESG factors. To be able to say, well,
sorry, what does that mean? Sorry.
So if you think about if you're measuring the performance of a fund, you can apply quantitative techniques to work out with quite a level of significance how exposed, for instance, your portfolio is to interest rates, to other macroeconomic factors.
Yes.
So this is what's called factor risk. So you can use this alongside looking at your sector exposure of your portfolio relative to an index. I've yet to see somebody sort of quantify environmental risks, the social risks we talk about, and the governance risks we talk about in a quantitative way, i.e., being able to say, well, look, of 2% outperformance, 50% of that was from ESG factors, and 150%, 1.5% from other factors. I've yet to see it. So until we get there, we're not going to be able to explicitly say there's a quantifiable cost or benefit. But intuitively, going back to this idea of stranded assets, intuitively it makes sense to me that there are certain bad activities, digging up hydrocarbons, selling cigarettes, that are going to become less popular and less valued activities going forward. So to avoid those in your investments is probably going to have a benefit.
Very cool. So if there's no reporting, at least as you've just given an example that 4% was from this and 1.5 was from ESG, how does an advisor deliver to a client that kind of reporting result?
Well, I think that becomes incumbent on the asset manager. An asset manager who claims to take into consideration environmental, social, and governance issues when they're picking the companies that they're investing in, it's incumbent upon them to provide some commentary around that. So, for instance, Another commitment that we make to our clients, and many of our peers do as well, is to engage with the companies that we invest in. That means we talk to them, we learn, in the process of researching a company that we might invest in, we talk to the company, we might meet with senior management. We're committed to do that. And we're also committed to ask, the questions around the environmental, social and governance issues that are material to that particular company. And then I write about it. So we, for instance, will write blogs about companies that we've had active engagement with. We publish, and again, it's a responsibility of ourselves and our peers to publish on a regular basis a record of our engagement activities. So shortly we'll be publishing a summary of our engagement for the last financial year. That includes 2 case studies of companies whereby we identified in one instance, an aspect of their governance, which meant that we felt that shareholders were not being treated fairly. We wrote to the board of directors. We engaged with the company that way. We didn't get the change that we required, so we wrote to the regulator. We didn't get the change we required after that, so we started to engage with the media. Publishing the letters that we had written to the company in a public forum, generating media interest around this subject, and eventually that pressure came to bear on the company, and they made the changes that we asked of them. So we're committed to be transparent. So what the advisors should be asking of their fund managers is to say, well, if you're claiming to be responsible investors, show us. You commit to full transparency. Show us all the holdings in the in your portfolio. Show us documentary evidence of engagement you've had with the companies that you invest in. Now, we, for instance, have absolutely no problem publishing every position that we hold in the public domain. Many of our peers, for instance, will only publish the top 10.
That's a common thing, right?
That's the common standard. So the question that an advisor should be asking, or a client, is that if a certain fund claims to be responsible, and yet you can only see their top 10 holdings, what's to stop them, on the one hand saying we don't invest in coal, but having their 11th, 12th and 13th holdings that they don't publish being invested in coal companies?
No, I definitely appreciated going onto your website and reading the blog about your day out on the boat with Philip Morris. I'm joking.
Look, it's a mantra we have, and again, this comes back to values. These values are shared amongst us as employees of the company. It's embedded in the culture of our company, and I say to my junior colleagues, live your life in a way that you're happy for that to appear on the front page of the newspaper.
Of course.
And that way, that says something about us, and that extends into how we believe we have an impact. We're not an impact investor, but we believe we have an impact by supporting companies that are doing positive things for the benefit of the planet and society, and also by calling out those companies that behave in a bad way.
And what is screening? What sort of positive and negative screening?
Okay, so this is back to the beginning of ethical investing. It's simply saying at the beginning of our business, our first client said, we do not want exposure to oil and gas, alcohol, tobacco.
Right.
So screening, a negative screen is the process whereby we say, we can invest globally. We define the universe of companies that we can invest in, and if you like, we mechanically screen out those sectors that we don't wish to be exposed to.
So I'm sort of imagining you've got a normal, say, long short fund over here, and then you've got an ethical long short fund over here, and you've got a passive and active over here, and you got ethical passive and active over here, and I'm like, domestic, international, whatever. Like, it's almost like or normal investing plus ethical exists everywhere, including VC, PE. Well, here's a question: how could you have an ethical bond fund? Like, what about bonds? Like, especially not so much corporate bonds, but sovereign bonds.
Well, let's start with corporate bonds, because that is a growing area within the responsible investing world. The way that works is that a company, they're called green bonds, unsurprisingly.
Right.
So a company raises money via issuing a bond, and they raising that money for a specific issue. For instance, investing in a utility company raising money to only invest in a solar farm, for instance.
Sure.
So the holders of that bond, who receive interest over time, are absolutely certain that they're financing something positive, as opposed to just financing general activities of the company. But there is a growing industry, green bond in the industry. At a government level, you asked the question. I think they're really. I'm not aware of product that invests in. Tries to determine whether or not governments are, ESG friendly. I mean, I think that's a harder task.
Definitely, yeah. That was my original thought. And then, so as an advisor, what would you say is the three easy things what's the three easy questions, three easy things that an advisor can do tomorrow if a client goes, knock, 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 I'm interested in ethical in some capacity? What's their first step? What should they do?
The first step is to go to the website of the Responsible Investment Association of Australasia, otherwise known as RIA. That's an industry body for fund managers, asset managers like ourselves, across all asset classes, so equity, bonds, private equity, venture capital. And they certify product.
Right. Okay.
Like the funds that we manage.
Right.
And that process of certification is really about looking under the hood and checking that we actually, practice what we preach. There's a lot of what we term greenwashing going on out there. It's the popularity or growing popularity of ESG product is not wasted on the marketing departments of many financial institutions. So product certification gives the advisor and their clients an additional level of comfort that the fund manager is actually doing what they say they're committed to doing.
Great.
So the RIA website has listings of products across all those different asset classes, also across the super fund industry, and also into some financial institutions, some banks that have also made commitments to behave in a more ethical way. So I would say that's a good place to start. Product listings there. The advisor can be confident that there's been a level of assurance, if you like, undertaken. Us as fund managers, to have our products certified, we have to fulfill an assessment on an annual basis. Sometimes there'll be a third-party auditor come in to check documentation and so on and so forth. The same is true of the PRI is a global body doing exactly that. The PRI publishes its assessments of its signatories, like ourselves, in the public domain. So it gives us a grade. We've just been through the 2019 assessment and achieved the highest ranking, A+ across all relevant modules. Puts us at the top of the pile here in Asia and also globally. So one of the purposes of that kind of industry organisation is to to provide a level of assurance that we are good to our word. So that's a good starting point. Then really it's about about asking us managers, asking us to show portfolios, asking us to talk about case studies where we've spotted risks in environmental risks in companies and engaged with the management to try and bring about change. It's just transparency is very helpful for the clients.
Awesome. And James, if there's any advisors out there that are interested to learn more about Morphic, about yourself, how would they go about finding out more about you or reaching out? Like, what's the process?
Look, a good place to start is our website, www.morphicasset.com. Again, we're committed to full transparency. There's a huge amount of resource there about our product, about our process. A lot of case studies around companies that we've been invested in. A lot of commentary on not just companies, but on macroeconomic views, issues, our view of the world. We're active contributors to newspapers such as the AFR. One of my colleagues is a columnist, has a column for the AFR on a regular basis. We're often called to appear on various business channels on TV and radio. We hold ourselves to a very high standard in terms of what we do, and also getting the message out there about what we do, because we believe we need to bring up many of our peers to those higher standards to achieve better outcomes for the broader world and society.
Right, get
on the website. Give us a call. We also hold regular roadshows around Australia, not just the major cities. We go out into some of the smaller towns where our clients are, and give clients the opportunities to ask questions of us. Again, that's how we allow our clients to hold us accountable. To call us out, and we do. We've got many a client who are have experience in particular industries that we might be invested in, and they call us out, ring us up. Are you aware of what this company's done here, and so on and so forth. It becomes a good two-way conversation, and of course we're always learning from that. And we certainly don't have a monopoly on wisdom, and would never claim to do that, but the best way we can demonstrate that we're true to our word is to put ourselves out there and let people ask questions. So on the phone, email, all our contact details are available on the web. We've got nothing to hide from.
Awesome, mate. Well, thank you so much for your time. Really appreciate you coming on.
Not a problem. Thank you.